2026 is the year Bitcoin either melts faces or breaks people. And the scary part is, both can happen in the same year. Today we settle one headline question, Bitcoin versus SPY and Bitcoin versus tech. When I say tech or Nasdaq, I mean the Nasdaq 100, and I use QQQ as the proxy. And when I say crypto, I mean Bitcoin only. I am not giving you a number. I am giving you a framework. Bitcoin is the extreme version of the stock market. Bigger upside, bigger downside, and way less mercy. If you want the smooth ride, you buy SPY. If you want asymmetry, you look at BTC. I'm going to be deliberately bold today, but I'm not going to fake certainty. This is my personal view, not financial advice, and we're doing it the right way, bear case, base case, bull case. And here's the price of admission. Bitcoin doesn't dip, it pulls the floor out. If a 20-30% drawdown makes you panic, Bitcoin will shake you out right before the move. Most people still judge Bitcoin like a tech stock. That is the mistake. Bitcoin trades like a global macro asset with its own rules. And unlike stocks, Bitcoin is 24/7. No closing bell, no weekend break. When something happens, BTC reacts immediately. That's why Bitcoin feels random to most people. It's not random, it's just faster, more reflexive, and brutally honest about sentiment. Bitcoin doesn't just trend, it flips between regimes, calm, squeeze, panic, and then euphoria. Headlines create narratives, narratives create flows, and flows move price. And Bitcoin is a flow-driven market. When money rushes in, it overreacts. When money rushes out, it overreacts even harder. This is why BTC stays more volatile than SPY and QQQ, even if it matures over time. And the return distribution proves it. Bitcoin has fatter tails, bigger wins, bigger gut punches. So yeah, your portfolio might look like a meme sometimes. Welcome to Bitcoin. Now let's clarify what normal really means for BTC, because most people mistake normal volatility for being wrong, and that assumption is flawed. Let us lock in thesis number 1. Bitcoin will remain more volatile than SPY and even tech. Not because it is broken, but because it is a younger, more reflexive market that reprices faster. Stocks trade in sessions. Bitcoin trades live, 24/7, globally, nonstop. That constant price discovery does not smooth out swings, it amplifies them. And this volatility is not just noise, it is the mechanism that creates the upside. If you want comfort, you buy SPY. If you want asymmetry, you step into BTC and accept the fee. Now here's the part most people never internalize. For Bitcoin, pain is normal, not exceptional. In our 5-year sample, Bitcoin printed roughly 39 pullbacks of 10% or more. That's not rare, that's the default setting. The average time between those pullbacks is about 48 days, meaning the market barely lets you breathe before the next shakeout. And the worst pullback in that window was around 48%, which is the kind of move that ends careers if you size wrong. Even a drawdown around 28% can be completely normal BTC behavior depending on the moment. So if you're watching a 20% move and thinking this is impossible, Bitcoin is basically saying, welcome. Here's why this matters. The same drawdown that feels like a historic crisis in SPY can be a normal week in Bitcoin. When you put BTC next to QQQ and SPY on a drawdown chart, BTC doesn't just dip at whipsaws. This is exactly why Bitcoin outperforms in bursts. It overshoots on the upside the same way it overshoots on the downside. But it also means your psychology becomes part of the strategy. If you can't watch red without panicking, you'll sell the lows and buy the highs guaranteed. So the question isn't, is BTC risky? It's, can you survive the risk long enough to earn the asymmetry? And here's the trap. Bitcoin often looks safest right before it becomes dangerous. Volatility compresses, the chart gets quiet, people get bored, and that's when positioning builds underneath the surface. Then the break happens, and BTC doesn't move, it teleports. This is why I don't just watch price, I watch volatility structure. When volatility tightens, it's often the market loading a spring. Not every compression leads to a breakout, but over time this rhythm repeats enough that ignoring it is a mistake. This is also where YouTube hype starts, because breakouts look obvious in hindsight and impossible in real time. Bitcoin is 24/7 and leverage turns normal pullbacks into waterfalls. So let's land this. Thesis number 1 isn't a prediction, it's the admission ticket. Bitcoin will likely remain more volatile than SPY and QQQ, and that volatility is the price you pay for the chance at higher upside. The market uses pullbacks to eject weak positioning, shake confidence, and reset leverage. That's why the path matters more than the destination, because most people don't fail on the final outcome, they fail on the ride. Now the real question becomes, what flips volatility from random pain into a sustained trend? The answer is the same thing that moves everything, liquidity. Here's the lens that makes Bitcoin feel less random. BTC is a liquidity thermometer. When liquidity rises, Bitcoin tends to heat up first because it's the most reflexive, flow-driven asset on the board. When liquidity drains, BTC doesn't politely cool off, it snaps. This is why your BTC chart often looks like it's predicting the stock market, when in reality, it's reacting faster to the same macro pulse. And that's the core idea for 2026. It's not a single price target year, it's a regime year. If you understand the regime, you stop being surprised. Rates are gravity. When cash yields a lot, speculative assets have to fight uphill because the risk-free alternative becomes attractive. In those periods, Bitcoin can still rally, but it usually needs a stronger narrative or stronger flows to overpower that gravity. When rates peak and start easing, the entire market's willingness to take risk tends to return slowly at first, then all at once. This is why I watch rates not as a prediction tool, but as a permission structure. Are we in a world where risk is allowed to run? If you ignore rates, Bitcoin will feel like a mood swing. If you track them, the mood swings start to make sense. Now, liquidity is the fuel. One of the simplest proxies is money supply. M2 doesn't cause Bitcoin, but it's a great backdrop for how loose or tight the system is. When liquidity expands, speculation wakes up, leverage grows, and risk assets catch a bid. When liquidity contracts, the market becomes fragile pullbacks turn into waterfalls, and Bitcoin usually takes the hit first. The important part is not the level, it's the direction and acceleration. In 2026, if we're in a reflationary easing environment, BTC has a real shot to outrun QQQ. If not, the upside is still possible, but the path gets uglier. Financial stress is the kill switch. When stress spikes, everyone sells what they can, not what they want. Bitcoin is liquid, tradable 24/7, and easy to dump. That is why BTC can look strong for months and then fall apart in days when stress hits. Digital gold is a long-term story, not a short-term trading plan. In stressed regimes, Bitcoin behaves more like high beta risk than like a stable store of value. So in my framework, stress is not a vibe, it is a signal. Stress up means protect capital. Stress down means risk can breathe. When liquidity hits, it doesn't drip in. Sometimes it shows up like a waterfall of money. Put it together, and 2026 becomes a simple map with brutal consequences. Rates tell you the gravity, liquidity tells you the fuel, stress tells you when the engine stalls. This is why I am bullish on Bitcoin long term, but still honest about the ride. The same market that can outperform tech can also punish you repeatedly, because volatility is structural. Thesis number 2 is simple. BTC has the higher ceiling in the right regime. If liquidity loosens and stress stays contained, Bitcoin can outrun tech. If liquidity tightens or stress spikes, tech can win by being sturdier. And that leads perfectly into the next chapter, because flows, especially institutional flows, can amplify these regimes. Let us get more factual. Bitcoin is no longer just a retail toy. The big structural shift is that BTC increasingly trades through institutional rails, ETFs, custodians, prime brokers, and corporate balance sheets. That matters because it changes how flows arrive, larger tickets, cleaner access, and less friction for allocators. It does not remove volatility, but it can change the timing and persistence of rallies, because flows can stick around longer than a weekend hype cycle. In 2026, one of my cleanest tells is simple. Do we see persistent net inflows into Bitcoin ETFs and other large allocation channels? That is why the BTC versus tech question becomes a flow question. Here's the scoreboard again, but now with the right interpretation, returns are not destiny, flows are. When BTC gets sustained inflows, it can gap up faster than tech. When flows reverse, it gives back gains faster than tech. That's why my thesis can hold simultaneously. More volatility than SPY and tech, but also the potential for higher upside. The correct takeaway isn't Bitcoin always wins. It's Bitcoin wins in the right regime. My 2026 take stays conditional. If liquidity loosens and stress stays contained, Bitcoin has a real shot to beat tech by year-end because it tends to respond first and strongest. If liquidity tightens or stress spikes, tech can win simply by being sturdier and better anchored to earnings. I am not pretending to know the exact print on December 31st, 2026. I am saying watch the flow channels, watch the macro regime, and size your exposure like volatility is guaranteed, because it is. Long term, I expect Bitcoin's annualized returns to drift downward as it matures closer to something like gold, but that's a multi-decade story. The near-term story is still adoption, market structure, and liquidity cycles. So yes, I'm optimistic on the future, but for 2026, I'm realistic about the ride. From here, I am not giving you a magic number. I am giving you a regime map. 2026 is less about prediction and more about which macro regime we land in, how easy money becomes, how stressed the system is, and whether flows keep coming. And yes, when I say tech, I mean Nasdaq, and QQQ is just the proxy on my charts. That is why the Bitcoin versus tech question is genuinely hard, because it is not one outcome, it is 3 plausible tracks. Bear, base, bull. And in each one, I will tell you what I watch to know which world we are in. Bear case. Liquidity stays tight or financial stress spikes. In that world, tech can win by default because it has earnings anchoring it and usually smaller drawdowns than Bitcoin. Bitcoin can still rally in parts of the year, but it is more likely to be choppy and mean reverting, with sharp sell-offs when stress hits. The tell is simple, stress up, liquidity down. Risk assets get punished, and Bitcoin often gets hit first because it is liquid and trades 24/7. If I see persistent stress readings and risk-free yields staying attractive, I size down and treat rallies as fragile. In this regime, survival beats hero trades. Base case, mixed signals. Liquidity is not aggressively loose, stress is not exploding, and flows are steady but not euphoric. In this world, BTC can grind higher but with painful pullbacks, while tech also performs. So the winner by end of 2026 becomes a coin flip. What matters is positioning. Are pullbacks getting bought? And do inflows resume after volatility spikes? This is the regime where most investors get chopped up because they overtrade. The play here is boring. Stick to your plan, respect drawdowns as normal, and do not let a single week rewrite your thesis. Bull case. Liquidity loosens while stress stays contained. That is the environment where Bitcoin tends to do what it does best, outperform in bursts, break levels quickly, and force everyone to chase. In that world, BTC has a real shot to beat tech by year-end, because flows do not drip in, they rush in. The tell is also simple: stress stable or falling, liquidity improving, and dips getting bought fast. I am not saying it is guaranteed. I am saying this is the regime where the upside tail becomes most likely. If you force me to answer the headline, BTC versus tech by December 31st, 2026, my honest answer is coin flip. But yeah, I lean Bitcoin. Now the part that decides whether you win, the playbook. Bitcoin doesn't reward intelligence, it rewards staying power. If you size BTC like a tech stock, you'll get emotionally liquidated before the thesis plays out. So treat volatility as a certainty, not a risk, I assume. 30% and 50% moves can happen even in a bullish year. That assumption forces better sizing, better timing, and fewer panic decisions. Two tools beat most forecasting: dollar cost averaging, or DCA, and rebalancing. DCA just means you invest the same fixed amount on a schedule, for example $100 every month, no matter what the price does. DCA prevents you from needing the perfect entry in a market that loves punishing perfect entries. Rebalancing prevents your portfolio from becoming a one-way bet after big moves. In practice, that means you set a target allocation and you rebalance when BTC becomes too large or too small relative to that target. It is not sexy, but it is how you convert volatility from stress into mechanical advantage. And it is how you avoid the classic mistake: buying after euphoria and selling after pain. And you needed validation points not for Bitcoin as an idea, but for your position sizing. If a stress spike hits, you reduce exposure. If your time horizon changes, you reduce exposure. If you realize you cannot sleep, you reduce exposure. Because the only unforgivable mistake is getting forced out at the bottom. My goal is not to be right on a chart. My goal is to still be in the market when the asymmetry shows up. Now zoom out. Over decades, I expect Bitcoin annualized returns to drift downward as it matures, closer to something like gold. That does not mean the price stops moving. It means the explosive early phase fades, and the asset becomes more widely held, more liquid, and more regulated. The irony is that the path may stay violent even as the long-run slope gets calmer. That is why the playbook matters more than the prediction. Alright, here's the whole video in 1 minute. Thesis 1 is simple. Bitcoin stays more volatile than SPY and tech, and that volatility is the fee you pay for asymmetry. Thesis 2, Bitcoin can still outperform tech, but only in the right regime. This isn't magic, it's mechanics. And the mechanics are the map. Rates tell you the gravity. Liquidity tells you the fuel. And stress tells you when the engine stalls. If liquidity loosens and stress stays contained, Bitcoin has the higher ceiling. If liquidity tightens or stress spikes, tech can win simply by being sturdier. So take the view, not the hype. This is not financial advice. Subscribe and tell me in the comments which 2026 regime you think we get.